Okay, so we've covered growth and financial strength. So now we're going to focus on what often separates good companies from great long-term businesses. And again, the type of investing that we're talking about here is a buy and hold strategy, right? This is not trading. This is not swing trading or whatever you call it, whatever you want to call it, day trading. This is for picking good long-term companies, core positions, if you will, in a portfolio. So the first one I'm going to look at is operating margin. Not every dollar of revenue becomes profit. And the operating margin shows how much money a company keeps after you pay the normal costs of running its business. I heard of a company this morning that made the news yesterday because they're generating like $10 billion a month in revenue. It's a new startup company and it's
Mhm.
woohoo. I don't know that they're making profit yet, though, or their operating margin is strong. Um, so an example here, company A sells $100 worth of products. Beth is going to yell at me because I'm using numbers. Sorry, honey. Company A sells $100 worth of products and keeps 8. Company B sells the same amount but keeps $22 instead of 8. Which business has more flexibility during a recession? Usually company B. So many investors look for companies with stable or improving operating margins over time. And again, the trend often matters more than the exact number. So if the margins are improving, that maybe you got to dig deeper. Is there new management that came in? Had they made some uh, changes that fundamentally change the way the company is running, and the trend is improving? That's a huge way to look at that is following the trend. So that's operating margin. Next up, free cash flow. And I'm not talking about government handouts here. This is and it may
And
be
this
the
is a
most,
big one, right?
it's a big one, maybe the most underrated metric on today's list, though. Free cash flow is the cash left over after a company pays its operating expenses and invests in maintaining or growing the business. Um, so after and they paid dividends, what's left? Free cash flow.
Hmm.
Why does it matter so much? Well, profits can include accounting estimates. There's an old
Uh,
saying, figures don't lie, but liars figure.
yeah.
Yeah, that happens a lot. And you can read in it. Okay, so a company comes out with their annual report and they have their press conference and it's woo, and everything looks wonderful. Uh, but then the stock tanks, and you wonder what happened, why? And oftentimes there are notes in the margins that the accountant puts in that kind of explains where the figures came from. And sometimes if you read it close enough, you can tell if they're fudging the
Oh,
numbers.
really?
Yeah, it's all there. They have to tell you. Legally they have to tell you. But sometimes they put things in such a way that you have to dig for it to get it. So you can't fake cash flow.
I was going to say it's hard to
The
fake.
cash is cash. Cash is
Yep.
there. If the cash is there or it's not, that's pretty easy. It's really hard to fake free cash. And companies that have strong free cash flow have greater flexibility to innovate. Right? They have
Hmm.
money to. It's not going to hurt them to spend money trying something new. They have more cash to pay dividends. If they are a dividend paying company, they've got a lot of free cash flow. That gives you more confidence
Hmm.
in the dividend. They can reduce debt. They can repurchase shares. Not always a bad thing, only bad if they're doing it for the wrong reasons. And they have the cash to weather economic downturns. So, a simple screen is to look for positive and growing free cash flow over multiple years.
Going back to share repurchases, if they purchase it out of free cash flow, not as bad as if they purchase with debt.
Definitely.
Okay.
Definitely. Yep. So next one, let's talk valuation. That's number 7 on our list, price to earnings ratio, PE ratio. And that's the one, I said EPS earlier, but PE ratio is really the one that people bandy about quite a bit. A wonderful company isn't always a wonderful investment if you're paying too much for it. So the PE ratio compares a company's stock price to its annual earnings. So again, here's an analogy, some numbers, easy numbers. Imagine you have two identical houses. One costs 300,000 and the other costs 700,000. So the more expensive house might still be beautiful, but you're paying a premium for it. They're identical, right? And maybe, you have no choice but to buy the $700,000 house, but Um, PE ratio helps you determine again, remember, stay within the industry, compare apples to apples. Are two similar investments, one is more expensive than another? There better be a really good reason. Better be a really good reason why you're paying more for that one. So instead of asking whether a PE is high or low, again, compare it to industry peers, compare it to the company's historical average. Which way is the PE moving? You can look at the expected growth rate of a company. A lot of companies put that out there. So, a higher price to earnings ratio might be justified for a rapidly growing business. And a low price to earnings ratio may signal an opportunity,
Mhm.
but also a warning. Also a warning. Valuation always deserves context. You have to know why.
And there are some industries with very low PEs, right?
There are.
Mhm.
Yeah.
But that
And
doesn't always mean they're unhealthy, or
correct.
does it? Okay.
Yeah. So you have to look within the industry, and again, the company's historical average. You look at the history of it and see where are we today. Is it a good buy now? Which brings us to our final metric for today: the dividend payout ratio. So a company's dividend is only valuable if it's sustainable. Jay, you and I have had many discussions about the dividend payout ratio.
Mhm.
It measures what percentage of earnings is paid out as dividends. So, as a general guideline, again, very general, and this is broad, but 30 to 60% often indicates room for growth and stability. Ratios consistently above 80%, you might want to take a really close look at that.
And aren't there some that that pay out more in dividends than 100%?
So, if you're looking at a high yielding investment, a stock, and you look at the dividend um, payout ratio, your dividend yield is another way to say that. And let's say the dividend yield is 10%. That's a really good dividend yield.
Mhm.
But then you look at the earnings yield, and maybe they're earning 8%.
Okay.
So where's the other 2% coming from?
Exactly.
Right?
Got to be debt.
Got to be debt, or they're using cash to pay the
Mhm.
dividend, right? Which is not really a good thing. And again, it's industry specific. A lot of times, if you look at real estate focused companies, their PE, I'm sorry, their dividend yields are out of whack because they use depreciation and a lot of accounting tricks to. Um, I'm not going to say fudge numbers. It's legal. I mean, it is what it is. The real estate industry has tax breaks and benefits that other industries do not. So when you're looking at dividend yield for a real estate company, it's a little harder. Um, you have to dig a little deeper. But as a general rule, if you've got a company that's earning less than it's paying in dividends, huge red flag. Really, really huge. I just avoid them. I don't even go there. So a high dividend yield isn't automatically attractive. Sometimes the yield rises because the stock price has fallen sharply, right? So
Mhm.
maybe so again, all of these things have to be taken into account. Um, you have to evaluate the dividend and the underlying business together. So putting it all together, let's review all 8 metrics and the questions they answered. First metric is revenue growth. Is the business expanding? Earnings per share growth. Are profits increasing? Is the question that answers. The question or the answer, return on equity, is management using capital efficiently. Is leverage under control? That's debt to equity. If you ask the question, is the business profitable operationally? That's operating margin. Does the company generate real cash? That's free cash flow. Is the valuation reasonable? That is the PE ratio, answers that question. And is the dividend sustainable? You look at the dividend payout ratio. And these metrics fall into 4 broader categories. Um, Growth is revenue and earnings per share. The quality of the company can be seen in the return on equity and operating margin. The financial strength can be seen in debt and cash flow. And the value can be seen in the PE ratio and dividend sustainability. 3 common mistakes to avoid. And these are big ones. Mistake 1, we already talked about a little bit: chasing the lowest price to earnings ratio. Stocks stay cheap for a reason. Cheap stocks
Mhm.
stay cheap for a reason.
And conversely, good to stay away from stocks with really high PE valuations, or no?
Not always.
Not
Again, are
always.
you in a
Okay.
growth industry? You in a tech stock that's currently on fire. Um, Now, if you're long-term investing, yeah, probably. If you're buying it and planning on holding it for years, um, as a general rule of thumb, low PE can be better, a better buy. Um, but yeah, again, Jay, you can't just look at one. You can't look at just one and say
Okay.
that. Um, Mistake number two, ignoring cash flow. So a company can report attractive earnings while struggling to generate cash. And cash flow can often reveal financial resilience. How are we going to do if the markets go down? Mistake number three, and this is a big one, looking at 1 year of data. Because, looking at the data at all can be tedious. Expecting someone to look at more than 1 year of data is, I mean, that's just too burdensome. So let's go this year. Let's just go ahead and do it. They had a great year. Let's buy it. You have to look at a trend. Businesses experience cycles, and whenever possible, 3 to 5 years of trend is way more desirable than a single snapshot of 1 year. And I've emphasized this over and over. I'm going to do it again. None of these metrics guarantees investment success. Markets will fluctuate, businesses change, managing investment risk remains critical. So if it seems like a lot, that's because it is. Many people realize that managing investments is a full-time job that they don't have time to do. So give us a call. That's what we do. You can call us at 503-8306. Visit our website, guardianplanners.com. Jay, do we have any time for some
We
fast
have
facts?
45 seconds for fast
I'm
facts.
just going to do one. Credit card debt in America stood at $1.25 trillion in the first quarter of this year, according to the Federal Reserve Bank in New York, which is a slight pullback from the prior quarter's record, but we're still up 5.9% from a year earlier.
And that does not bode well for the future,
It
correct?
does not. Credit card debt, government debt record highs. Of course, every week is a new record high for
Sure.
government debt. So that's going to be a problem. We're going to see it more and more. So more than ever important to manage debt, or risk rather, which is what we specialize in at Guardian Planners.
Okay. And Guardian Planners, how do they get a hold of you?
C. Johnson at guardianplanners.com is the email, or call us 503-8306.
All right. That's another exciting show of Sound Money Management. And again, if you missed it last week, go listen to the show. And then you'll be able to put that one together with this one. So thanks for listening. Kilmeade next after the news on Connect FM.
Johnson is an investment